I'm John Rees, partner of Freshfields, based in our London office and head of our international oil and gas group. Attached to this video you'll find a report which we're circulating in part in response to a growing awareness that the current economic crisis may affect the oil industry in ways which were not immediately obvious at the beginning of this year. The report brings out some of the themes which we and our clients are encountering as the recession continues to bite, causing lawyers, banks, investors and oil companies to reappraise some of the assumptions which were both unwritten and, dare I say it, unquestioned at a time when different rules applied. I'm going to touch on three of those themes now. First, on the debt front, there's obviously been a sea change. Banks are no longer willing or able to make financing available to support optimistic forecasts of work programs, commodity prices and cash flows. There have already been some well-publicised casualties amongst the oil companies whose business plans were based on turning heavy short-term capex into longer-term positive cash flow. However, these cases are not merely the consequences of unfortunate timing differences. They're also illustrative of a structural and cultural change in the relationship between oil companies and their lenders. Adversity to risk has become the order of the day among the lending banks, not only with those borrowers who are obviously vulnerable. And we don't believe that all borrower oil companies have yet grasped the implications of this in their financial planning. Put simply, any oil company which is unable to demonstrate that it's thought through carefully how it is going to survive further deterioration in its business environment is going to be operating on a different wavelength from its lenders, and sooner or later is likely to encounter problems. A second factor which may have been overlooked is that the oil industry, particularly in the upstream, is heavily dependent on joint ventures. We've seen several companies, ostensibly with no financial problems of their own, put under pressure by the problems encountered by their partners. Exploration programs which have not been cut, as well as a number of development projects, are in some cases being delayed as a result of the financial constraints of partners, sometimes with serious consequences for cash flow projections. In acute cases, we're seeing healthy oil companies having to come to terms with insolvency provisions, including industry standard form provisions, which simply fail to address the fact that international insolvency and creditor protection practice has moved on enormously since those clauses were drafted. Thirdly, in the M&A sector, we're experiencing an upswing in activity, particularly in the public markets. The collapse in share price has caused a perception that there are plenty of bargains about, which has in turn created a flurry of activity within the M&A teams of the larger oil companies, often encouraged by the sense that previously long-term equity investors are keen to exit and cut their losses. This activity has caused a significant added distraction for smaller companies, particularly those whose equity story has been undermined by recent events, often exactly the same companies who are under pressure in their relationships with their bankers. As a result, lots of companies are feeling vulnerable at the moment, although not everyone has grasped the nettle of implementing a strategy and the necessary tactics to ensure their equity investors will choose to hold on for the long term, if and when that choice presents itself. I hope you'll find the report helpful. The year ahead promises to be an interesting one.